Hello, my name is Peter Babitch, this is Nicholas Fontinovo, and this is Harrison Goad. And today we would like to welcome you to our market view presentation. We'll be looking at two currency pairs as well as the indicators that affect them. The first currency pair is the Australian dollar and the US dollar, which will be looked at in detail by Nicholas. And the second currency pair will be the euro and the Japanese yen, which will be looked at by Harrison. We will be looking at three indicators from both currency pairs as well as other factors that have changed recently that may have affected the currency value in the next 3 to 6 months. One indicator we'll be looking at is the inflation rate. Inflation can be defined as an increase in the total price level, and the price level is measured by the Consumer Price Index, or CPI. The CPI is a measure of the total cost of all the goods and services and normal consumer purchases. Therefore, the inflation rate is the percentage change of the price level between one period and another. High inflation suggests a decrease in the purchasing power of a currency. Once it's compared to another currency, it becomes clear that you can't buy as much with a highly inflated currency, meaning this currency is comparatively less valuable. The second indicator is interest rate. An interest rate is the amount of interest that is due per period on a principal amount. High interest rates decrease demand for borrowing money, encouraging price decreases, particularly in large investments. This encourages foreign investment and therefore increases demand for a currency and therefore a higher exchange rate. Interest rates have been chosen as their economic device determined by a governing body, instead of a report of previous activity. Interest rates are being considered as a deliberate influence on relative currency value. Another indicator is the economic growth rate. This is a tool that measures economic growth from one period to another in a percentage form, such as the rate of change of a nation's gross domestic product, or GDP. An increase in economic growth can lead to an increased imports, meaning more supply of a currency and decreases in equilibrium currency value. However, it may also lead to an increase in overseas investment, meaning more demand for a currency, and therefore an increase in equilibrium currency value. Economic growth rate has been selected for this market view as it needs in-depth consideration on a case-by-case basis. I'll personally be discussing technical analysis for each of the currency pairs. Technical analysis is the study of past price movements in chart form, guiding investors to make forecasts on future price movements. This has been selected to provide a clear picture about patterns in currency value changes, so future changes can be anticipated. Nick will begin by looking at the Australian dollar and the US dollar.
Currently, the AUD is trading at 0.7976 US cents as of the 19th of September. In terms of relative inflation rates, Australia's inflation rate is currently at 1.9% as of June this year, reported by the Australian Bureau of Statistics. Compared to the US, whose inflation rate is currently 1.6%, reported by the US Bureau of Labour Statistics. Comparing these two rates, what is essentially going on is that the general prices of goods and services in Australia has increased at a greater rate than that of the United States, experiencing a 0.3% higher rise. Due to higher relative rates in Australia, it decreases Australians' purchasing power relative to the US. This increases the supply of AUD as traders are trying to buy US and therefore sell AUD. As a result, it will cause the AUD to depreciate against the US dollar due to a shift to the right of the supply curve. At the last RBA meeting, the cash rate remained unchanged at 1.5% for the 11th straight month, in comparison to the US Fed's fund rate, currently at 1.25%. Although it is a higher relative rate to the US, 1.5 is a low rate by Australia's historical terms. A higher relative rate, however, encourages capital inflow into the Australian economy, which increases the demand for AUD. It also discourages capital outflow, which restricts the supply of AUD. This places upward pressure on the exchange rate, causing an appreciation of the AUD against the US dollar. Furthermore, as reported by the World Bank, Australia's real interest rate is 5.9% compared to the US of 2.2%. As a result, Australia is less likely to then depreciate against the US dollar due to higher real returns that it receives. The growth rate that Australia has experienced in the year ending 2016 was 2.8%. That was 1.2% higher than the US growth rate of 1.6% in the same period, as reported by the World Bank website. Higher relative growth rates indicate a higher relative growth in incomes, as suggested by an increase in GDP per capita. This stimulates demand for imports, resulting in an increased supply of Australian dollars. At the same time, stronger growth stimulates interest in investment into the Australian economy, raising capital inflow, increasing the demand for Australian dollar. As seen by the graph, exports have increased, which has contributed to the GDP growth, which shows an increased demand for Australian dollar. Coupled with capital inflow, a shift to the right of the demand curve will lead to an appreciation of the Australian dollar against the US dollar. In other economic news, economic journalist David Cottle points out that the AUD was lifted due to a weaker expected drop in the US CPI because of the US attempting to adopt a tightening aggressive monetary policy, but they only experienced lower drops in CPI. This compounded with the creation of 45,000 full-time Australian jobs, strengthening income and growth within Australia, drawing investment to Australia, raising demand for AUD, and appreciating the AUD against the Australian dollar.
This chart shows the exchange rate trends for the Australian dollar and the US dollar and can be used for technical analysis. There are different trends that can occur through the cycle of the exchange rate. The first seen here is a rising trend channel, followed by a declining trend channel, then a rising trend channel that finally stabilizes with a flat trend channel. This indicates the most appropriate time to buy and sell currency. Our sell point is when the declining trend begins and is expected to continue. The highest point prior to this decline would have to be a peak. Another rising trend indicates another buy point, with the lowest point before that being called the trough. It appears that the current flat trend is replacing what would be declining trend, which would usually be followed by a rising trend. We still expect this rising trend to occur. Therefore, the Australian dollar is expected to appreciate against the US dollar in the immediate future.
Due to stronger relative growth in Australia, alongside relative high interest rates, the demand for AUD is strong, stronger than the shifting supply for Australian dollars, leading to a potential upward pressure of the AUD in future, causing currency to appreciate against the US dollar. As we can see on the demand curve, we move up the supply curve to a new high equilibrium exchange rate above what we are currently trading at.
Currently, the euro is trading at 132.85 Japanese yen as of the 19th of September. In terms of relative inflation rates, the euro's inflation rate is currently 1.5%, as reported by the European Central Bank, compared to Japan, whose inflation rate is currently 0.4%. When comparing these two rates, the general price of goods and services in Europe has increased to a greater rate of that of Japan, which is experiencing a 1.1% higher rate. Due to relative prices, purchasing power in Europe decreases relative to Japan, which created demand for imported goods. This increases the supply of the euro as traders are trying to buy Japanese yen and therefore selling the euro. As a result, it will cause the euro to depreciate against the Japanese yen due to the shift in the right of the supply curve. The European Central Bank has left interest rates remain unchanged at 0%. In comparison to Japanese, interest rates is also unchanged, currently at -0.1%. A higher relative rate encourages capital inflow into the European economy, which increases the demand for the euro. It also discourages capital outflow, which restricts the supply of the euro. This places an upwards pressure on the exchange rate, causing an appreciation of the euro against the Japanese yen. As a result, the euro is less likely to depreciate against the Japanese yen due to higher real returns. However, the difference in interest rates is very minor. Whilst there will be an effect on the interest rates, it will be very unlikely that there will be a dominant factor in any change. The growth rate that Europe has experienced in the year ending 2016 was 0.6%. This was exactly the same as Japan, who also experienced an increase of 0.6%, as reported by the World Bank website. This identical growth rate indicates the demand for imports is the same, resulting in no change in the size of the euro. On top of this, there will be no shift in the demand curve, which will mean no appreciation of the euro against the Japanese yen. Overall, it can be forecasted from these factors that there will be very little effect on the value of the euro and the Japanese yen. Therefore, any major change will be due to external factors. One reason could be because Japan is the only developed country whose central bank is expected to continue with its own monetary accommodative policy. This can create uncertainty and weaken the value of the Japanese yen and lead to the euro being stronger in comparison.
This chart shows the trend for the euro and the Japanese yen exchange rate. It begins as a stabilized trend, which moves along into a declining trend. It then moves into a rising trend and finally returns to a stabilized trend again. The first buy point is the rising trend when the investor believes the trend will continue.
The lowest point beforehand is the trough. A limitation of the TA is that a clear trend is needed to predict future movement. Without an indicative movement, particularly towards the end of the TA, we cannot confidently set expectations about exchange rates. Therefore, TA results cannot be applied in this case, and Harrison's stance remains unchanged, meaning the euro to Japanese yen exchange rate is not expected to change.
Overall, we found that the Australian dollar will appreciate against the US dollar. This is due to stronger growth, better interest rates, and this will overcome for the inflation factor. Looking at the euro and the Japanese yen, it is expected the euro will remain constant with the yen. Thank you.